Okay, it's 12 now, and it seems like we have a stable group of participants here. Thank you for joining us. Welcome. Today's webinar is called Prepare Your Farm for Tax Season Now. And your speakers will be Florencia Colella, that's me, and Corey Clark. We are farm business management educators with Michigan State University. My pronouns are she, her, hers, and I am multiracial. And Corey, would you like to introduce yourself?
Sure. I'm Corey Clark. My pronouns are also she, her, hers, and I'm a farm management educator with Florencia.
In the thumb, right?
In the thumb, yes.
Okay. Welcome again, everyone. So before we start, we would like to acknowledge that MSU occupies the ancestral, traditional, and contemporary lands of the Anishinaabe, Three Fires Confederacy of Ojibwe, Odawa, and Potawatomi peoples that was seated in the 1819 Treaty of Saginaw. We would also like to acknowledge those who preceded us in farm record-keeping education, and also wanted to let you know that farmers have been keeping records for 11,000 years. We hope that this tidbit, and knowing that we have a group of over 20 people here today with over 55 people registered, we hope that this encourages you to feel that the work that you do matters a lot. So without further ado, let's get started. And we are going to start with the question of whether you're running a commercial farm. You can find the Internal Revenue Service's definition of a farmer on the cover of the Farmer's Tax Guide, IRS Publication 225. And if you don't have this guide already, I suggest you download it from the IRS website. So in a few words, it defines a farmer as someone who operates a farming business with the intent of making a profit. The full definition is on the slide. And on another hand, an activity is considered to be a hobby by the IRS if it's primarily for fun, recreation, or sport without any intention of making a profit. The IRS will presume a farming activity is being conducted for profit if it produced a profit in at least 3 out of the past 5 tax years, including the current one. Equine operations are a little bit different, with a presumption of profits in at least 2 out of 7 years. But if this test is not met, it doesn't automatically mean that the activity is a hobby. Instead, the IRS will consider other criteria, including the extent to which the activity is conducted in a business-like manner, the expertise of the taxpayer or his advisors related to the activity, the time and effort spent, the expectation that there may be that assets used in the activity will appreciate in value, the success of the taxpayer in carrying on other similar activities, the taxpayer's history of income or losses with respect to the activity, the amount of occasional profits, if any, the financial status of the taxpayer who may be interested in offsetting other sources of income, and finally, the elements of personal pleasure or recreation. So any income from a hobby farm is reported on the first page of the U.S. Individual Income Tax Return, or Form 1040, under Other Income, and it is taxable. You used to be able to deduct hobby farm expenses to the extent of the farm's income, but that's not the case anymore, so you will be taxed on your hobby farm's gross income, independently from any expenses you incur. On the other hand, income from a commercial farm is reported on Schedule F, which is an attachment to Form 1040. And its expenses are deductible, even if they go above income. So if your commercial farm operates at a loss in some years, those losses can be used to offset your overall income tax liability. Of course, this makes it convenient for you to call your farm a commercial farm, but can you prove your farm is a business? If you are audited, the IRS will look at whether you can prove that your goal is to make money from farming. The good news is that the practices needed to show the IRS that you are in farming for its potential profit, even if you aren't making money right now or this year, are the same good practices that will eventually make your business a successful one. This is a list of things that the IRS will look at. Note that the fourth is keeping records. Being a hobby farmer or homesteader are great lifestyle choices too, and they may fit your specific situation better. We hope that these tips help you prepare for tax season, whatever your income sources or lifestyle choices are. So now we're going to dive into record keeping. We said that in order for farm businesses to even be considered businesses by the Internal Revenue Service, they need to have accounting records. There are 2 main accounting methods, accrual and cash. The IRS allows farm businesses to use either method, but once you pick one, you are required to get their approval to switch back. Under the accrual method of accounting, you report income in the year it was earned or due, even if the payment was not collected. Expenses are similarly deducted or capitalized in the year they were incurred, not necessarily made. For example, if you used an item to grow a crop, you would account for it even if you haven't paid for it to your supplier yet. One good thing about the accrual method is that it matches income and expenses for a certain production year, providing a more accurate assessment of profit. This assessment of profit is often shown in what's called the income statement. On the other hand, the accrual method is less flexible in terms of tax management. It requires more time and information, and it may result in paying taxes on anticipated revenue. Most farmers use the cash method because they find it easier and are able to better match farm cash flows with the taxes due. Under the cash method, income is reported in the year it is credited to your bank account. Expenses are deducted in the tax year the expense is paid. However, a cash-based income statement does not reveal true profit. Thankfully, you can convert the cash-based income statement to an accrual or adjusted or true income statement by adding or subtracting year-end inventory adjustments for grain, feed, livestock, receivables, and payables to your income and expenses on an annual basis. If that's already sounding complicated, you can get help for that free of charge from these folks here who are MSU Extension's Farm Business Management Educator. But you do need to have all the information for the year first. So business transactions are normally first recorded in a journal fashion. Once entered in the journal, transactions are usually grouped by account and summarized in a general ledger, showing a balance for each account. Oh, and by the way, do you know what is a chart of accounts? It is a sometimes long list of different categories that you need to keep track of. Not all may apply to you, but here to the left, there's a list of income accounts. To the right, there's a series of expense accounts. And while not pictured here, there's also asset, equity, and liability accounts. So while accounting may seem complicated at first, there are many tools you can use, and many of them are free of charge. Here's a few examples. You could keep pictures of your receipts instead of paper ones, which is where Google Drive, Google Photos, OneDrive, and Office Lens come in handy. If you choose to use an electronic storage system, you may destroy the original hard copies as long as the IRS is able to determine your correct tax in an audit. For keeping track of transactions, there are plenty of applications you can download on your phone or use on your computer. Total, Mint, and Wave are just a few examples. I believe all banks these days give you access to Excel records of your transactions. And of course, there's also Google Sheets. And finally, why not use good old paper and pen? Any of these will be better than a shoebox of discolored receipts at the end of the year. So I want to briefly introduce you to the Farm Records Book for Management that you can use to enter your transactions on paper. It is available for $15 on the MSU Extension online bookstore, or you can also get it for an extra fee from your local extension office. We're working on translating it into Spanish as well. So here's a picture of the booklet. And if you prefer to work on the computer, you can go to bit.ly/Farm Records Book on your browser and access the Farm Records Book free of charge. Then you can either print it at home, download it to Excel, or use it right into Google Sheets. I'll show you how to do this in detail later. The Farm Records Book for Management is basically a set of tables where you can enter your transactions by date in the different categories. It's organized the same way income taxes are, so a benefit is that it makes tax filing easy, whether you are doing it yourself or you're using a tax preparer. On another hand, the Farm Records Book was designed to be simple, so it does not have formulas. So it's up to you to add up things right or enter formulas in the spreadsheet yourself if you prefer. If you are into formulas or a bit more complex spreadsheets, though, you can try the Farm Cash Tracker, which you can find in this link here. The Farm Cash Tracker has a few benefits over the Farm Records Book, and it's also free of charge. It lets you copy and paste reports straight from your bank or application websites. It lets you work with several different cash and checking accounts. So for example, if you sometimes transfer money between different bank accounts or want to keep track of movements between cash and bank accounts, the Farm Records book does not have an easy way to do that, but this one does. This is because it uses a double entry system. That's why you see incoming and outgoing account columns here to the right. This is as opposed of a single entry system like the Farm Records book has, where each entry is treated as if the offsetting account was the cash account. This tracker also has a summary page that will summarize your transactions per month and as a year total to the right, and give you net income and cash flow information, among other things. So speaking about record-keeping systems, if you happen to think you are ready for a paid record-keeping system, let me recommend the Telfarm program, in which for only $550 per year, you get all these things listed here. The most important of which being, in my opinion, the fact that they review and back up your work. But there's also tax benefits and a lot of education, and they work with QuickBooks and PCMars, which is another record-keeping software designed specifically for farms. So the first and most important financial management tool available to you is your records. With 3 to 5 years worth of records, either past or potential, you can analyze virtually anything on your farm, even productive matters, and make truly confident decisions. Okay, so now we are going to take a brief break. Switch over to Corey's presentation, and in the meantime, maybe see if there are any questions. So I'm going to stop sharing, Corey, and you can start sharing if you want. It doesn't seem that there are any questions at this point, so there is a Q&A icon at the bottom of your screen. Oh, here, there's a question coming in. Do you know what is tax deductible for your farm? Yeah, that's one thing that basically either you'll have to ask your tax preparer or you'll have to review in the Farmer's Tax Guide, or maybe Corey can give you more insight about that.
I was gonna say, we'll provide some insight there in the next couple minutes.
Awesome. Okay.
But I do leave a few things to your tax preparer because this stuff can be very complicated.
Okay, Corey, I am seeing your screen, not in presentation mode yet, but yeah. And maybe
are we ready?
I don't know. I don't know if people want to take 1 minute to stretch a little bit, but we'll probably get going soon. I said we could keep going.
Ready to go?
Yeah.
All right. So we are going to take a walk through farm record keeping for taxes. Because like we tend to think of records as like, how do I keep good enough records for taxes? But it really helps to think about how do taxes work and then figure out what's involved in keeping the records for those taxes. So we'll talk some about taxes, but mostly about how do you translate that to effective records. So tax forms. Taxes are complicated. I've seen these are a lot of the tax forms you would need, but I've seen tax returns that are a lot longer. But here's the thing. Your tax preparer is the one that's going to deal with the tax forms. You don't have to know the forms. What you really need to do is provide the tax preparer with the information they need to complete your tax return. So farm records do not have to be complicated. You have to keep a complete set of records for all your transactions of funds in and out of the business. But there are only 4 places where funds can come in and out of the business. There's farm operations, so like the income from selling your products and services and the expenses that it costs to produce those products or services. Assets, so you purchase assets to produce income, equipment, land, that kind of thing. And then the funds that come in from selling those assets. Debt, you may take out loans to purchase assets or maybe seasonal operating loans, and then you would make payments on those loans periodically. And finally, funds you may take out of the business or put into the business from family living. So family living expenses, which are withdrawn, family money that's put into the business to make sure it has enough cash. So I've put these categories into a table so that we can connect the cash in and the cash out of the business, and translate that to what this means for taxes. So here, green is funds into the business and red is funds out of the business. So of course, farm income and expenses, pretty straightforward. Funds go in from operating income, funds come out of the business for operating expenses. Then assets, when you sell them, they provide cash in. Assets purchased move cash out of the business. Debt, when you might use to purchase the assets. Borrowing funds brings cash in, and paying off debt takes cash out. And finally, family living. If the family contributes to the farm, that puts funds in. Withdrawals for family living expenses take funds out of the business. So now we'll connect this to taxes, taxable income, tax deductions, and then what's not tax related. And we're going to go through the same ins and outs, but this time related to taxes. So farm income and farm expenses, farm income is taxable. Farm expenses are tax deductions. Taxes on assets, a little more complicated. When you sell an asset, it's not the actual sale that's taxable, it's the gain from that sale. And when you purchase an asset, it's not the actual purchase that's deductible, it's the depreciation that purchase generates. And we'll talk about this in some more detail. And then debt. So also not quite as straightforward as operations. Principal borrowed and principal paid, that's not tax related. So it's not income to take to get loan funds, it's not deductible to pay them out, but the interest paid is deductible, and that's an expense that we'll talk about a little later. And then finally, family living contributions, family living withdrawals, not tax related at all. There are some personal income and expenses that are important for taxes, like wages and that sort of thing, but how the funds interact with your farm is not a tax issue. Okay, the first page of the Form 1040 calculates your adjusted gross income. So this is where your overall tax liabilities derive from. And then that's the start for your state tax calculation. So outside of the farm, you have things like personal wages or maybe some Social Security income. That's all part of your adjusted gross income. And then the farm contributes through net farm income, which is about income and expenses. And also that interest and depreciation, and then capital gains income from the gains on asset sales. Okay, so let's go back to how the farm transactions relate to taxes. And we talked about how the farm generates taxable income and tax deductions, and noted that principal borrowed and paid is not, and family living withdrawals and contributions, those are not tax related. I'm going to flip these two rows to make our next discussion go smoother. So notice the arrows, and then this is the same table with those rows having traded places. And so every transaction that you make on the farm, from checking or savings or whatever, is going to happen somewhere in this table. But only the transactions in the purple box really impact farm taxes. So again, not debt principal, not family contributions and withdrawals. Whoa. And there's a few things in your personal taxes that will matter, personal items that will matter for taxes, like health insurance for a sole proprietorship or partnership for the owners. And we're not going to cover that here, but some of the personal expenses are important to record, but they're not related to the farm taxable income. Okay, so this is the table we're going to work with going forward. Two main schedules in your tax return that cover these type of income and expenses. Adjusted gross income, and the two schedules flow into the adjusted gross income on the 1040. The first one's the Schedule F, and the second one is the Schedule D. So farm income, farm expenses, interest, depreciation, they all go into calculating your net farm income, which goes in your Schedule F. And Schedule D does all the asset sales stuff. We'll talk about the gains in the last section. Okay, Schedule F. Okay, let's see. Okay, We're going to take one section of the business at a time. So first, income and operating expenses. Okay, Florencia talked about methods of accounting, and farms do typically use the cash method of accounting for tax purposes. So income is recognized when the payment becomes available to you. So like when you actually sell the crop or the livestock and get paid. And then on the expense side, it's when you actually write the check or pay with a credit card. So what that means is that in 2020, if you carried over 2019 inventory, that's 2020 income. If you prepay expenses for next year, that's a 2020 expense, which this offers the opportunity to manage both your cash and your taxes. Okay, so products you sell. Crop, livestock, any farm products, resale products, any of this stuff. Important difference between purchased items that you're essentially reselling and raised items. So purchased items like feeder livestock, say that you're raising to sell finished cattle. The purchase price of those feeders is not an expense until you sell it as a finished steer. And the purchase price is actually up here in income, and it's deducted from the sale of the product. So that's like cost of goods sold. And you have to match up those original purchases with the sale. And then, whoops, let's go back a second. Raised items. It's helpful to separate crops and livestock, but from a tax standpoint, crops and livestock are the same, except breeding versus market livestock are different. So when you sell market livestock, it goes on in this section of the Schedule F, but breeding livestock, like cull cows for beef or dairy, that's an asset, and it goes with the asset sales. Now, rental income. If you rent out land or buildings, that is typically not farm income. It goes on a Schedule E, and the wonderful thing about that is there's no self-employment tax. Net farm income, on the other hand, is subject to self-employment tax. And if you materially participate, labor or management, in the farm that rents the land, then that rental income is farm income and goes on the Schedule F. And then there's, of course, a lot of other sources of income. Crop insurance is one of those places. One thing that's important to note about crop insurance is you may get the entire claim, or you may have the premiums deducted from it. I'll talk about that in a minute, but you want to record both the gross income from the claim and then separately record the deduction for premiums. CCC loans, it's a crop thing for the most part. It can be treated like a loan or income. This is something you want to label really well and talk with your tax preparer. And then government payments, especially this year, they get tricky too. Talk to your tax preparer about these because direct payments like the MFP trade payments, the CFAT payments this year, those are just regular income. But if you did a program like PPP and have loan forgiveness, that's like a whole nother world. So you'll likely get a 1099 at the end of the year, but in tax planning, you might want to talk with your tax preparer. Cooperative distributions, that's like patronage dividends. You might get both a check and on a statement that says you have an equity portion. Those are both income, and that kind of thing would be on a 1099. And then there's a catch-all for all the other income, like hedging gains, for example. Okay, so the Farm Records book from MSU Extension provides a nice place to record income, expenses, debt, asset transactions, all that stuff, and it's consistent with tax records. When you're recording a deposit, you want all the typical stuff, date, what the income's from, and the amount. And also the buyer might matter, in part for looking up later, and also it might matter if the buyer was a cooperative. And all that's in the columns with the green bar above it. So as an example, the June 26th sale of corn, you would have corn in the item description, and the buyer is, in this case, Anderson's. And then the quantity measure and and what it is, those are in the on the right side. And there's 4 or 5 pages of different columns, so the entire Schedule F is represented. And you would put the amount of that type of income in the column. So for June 26th, you might have 1,000 bushels of corn at $4. You put 1,000 in the quantity column, and $4,000 in the corn column. And then let's see. Okay. Gross sales and then the deductions. This is like the crop insurance thing. So when you have gross sales like crop insurance or commodity sales like corn, milk, whatever, there's a gross sale amount, and then you might have deductions. That might be hauling, drying, marketing, might be a loan. And so you want to record the gross sales up here in the income, that's section 1A, and then the deductions that are expenses, again, hauling, drying, marketing, separately into the expenses section. And this really is very important when you have, so the third thing, it's really important if it's a loan, because again, that paying back a loan is not tax related and you want to get those amounts separate. So you would put a loan payment into the loan section. And then, as I mentioned before, the purchases for resale. Note I said that you can't deduct a product that you've purchased for resale until you sell it. And there's special columns in the farm records book for those products. On the income side, the income column, it's labeled purchased, feeder, cattle, sold, but it can be any resale product. And you'd record the deposit information and the quantity and dollar amount sold. And then in the expense section, there is a column for feeder cattle bought. And again, that's the purchase of any resale product. And you record the date, quantity, price so that you can match up those transactions when it's time to prepare the taxes. Okay, let's shift our attention to expenses. We talked about operations generating expenses, and there's about 15 lines of operating expenses on the Schedule F. So like the chart of accounts that Florencia showed earlier, that should really drive your categorizing the operating expenses because it's similar to the Schedule F. And we'll go through a few important specifics, and then we'll talk about interest expense associated with debt payments, and then depreciation expense, which comes from your asset purchase records. Okay. So repairs and maintenance. I'm going to talk about some of the expense like kind of groups or categories and some of the things you should be aware of in keeping your records. The big thing for repairs and maintenance is that auto expenses, cars, light trucks, those need to be separated out from farm equipment repairs. There is some specific things you do with car and truck expenses that is different than farm equipment repairs. And the specifics talk with your tax preparer, but as you're keeping your records, note that those are separate. And then building repairs is, third separate thing. Equipment leases. They're only an expense if they're operating leases. So short-term leases definitely fit into this expense category. But if it's a longer-term lease, especially if you're required to buy the asset at the end, that gets treated like a loan. Another thing to talk with your tax preparer about. And then taxes. Certain kinds of taxes are deductible. And certain ones aren't. So real estate taxes, those are deductible as a farm expense if you own the land and you're using it for farming. And you should probably itemize those if you are using the Farmland Preservation Credit Program in Michigan, or PA 116. Payroll taxes, like your employer portion of Social Security and Medicare for your employees, those are deductible. And then personal property taxes are on the Schedule F, but not so much a thing in Michigan. Estate taxes, things that are not deductible as taxes. Estate taxes, personal income taxes, and then self-employment tax does not go on the Schedule F, but there you can deduct a portion in the personal part, the individual part of your tax return. Insurance, crop insurance, property and casualty insurance, liability insurance, those are all common deductible insurances. Health insurance for you and your family is not a farm expense, but it goes on your personal 1040. And then life insurance is not deductible at all in most cases. Employees and employee payroll expenses. Two kinds of labor. There's employees that you would provide a W-2 for, and there's contract labor. So all of the things essentially that you're paying for your employees is deductible, although potentially on different lines. The payroll taxes that you are paying the employee benefits, like if you make a retirement contribution for them, those are all deductible. Whereas contract labor, you wouldn't have withholdings. The part that you're keeping track of really is what you're paying, what you're directly paying them. So we get to the bottom, and that's the net farm income. All this stuff together, income minus expenses is your net farm income. And that number, like I said earlier, flows through to your personal, your individual return, the Form 1040. As Florencia said, it's important to note that this is calendar year profits. So it does not necessarily reflect a production year. Tax planning matters, which is why these records are one of the reasons the records are useful. But if you want to, analyze the management of your business, it does take another couple steps. And our team of educators, along with some, a number of consultants, do work in that area. For the farm records book and record keeping with expenses there, first you record the check information, date, vendor, check number, amount, and then the expense categories. Similar to the deposits or the income, there is multiple pages of columns to make sure that you have all the categories you need. And then, as I said before, there's columns to record the purchases for resale. So interest. Interest expense records are interest expense is part of debt payments, and that's pretty straightforward. And this goes on Schedule F as a tax deduction. And then, of course, debt principal, as we've talked about, borrowed, repaid, not tax related. Interest is down here on line 21, and it's important to split out the different kinds of interest. In particular, the interest on a real estate mortgage for farmland, for example, goes on a different line than other kinds of, the interest paid on other kinds of loans. And in the farm records book, there is a section for loan transactions. So in the farm records book, you're actually going to keep information about the loan borrowings and repayments that just, along with the interest payment, it just, some of it goes, the loan part doesn't go on taxes and the interest part does. So in the loan section, you label the date and the creditor. And again, label the who, because you may need to track this down later for separating out the type of interest or matching up multiple payments. And so you put in the beginning loan balance for the period, like the year when you're keeping the farm records book. And then let me go back a second. Sorry. So the beginning principal owed at the beginning of the period, and then any additional borrowing might be one time, might be an equipment loan, at the purchase of a piece of equipment, that goes in this next column. One thing to notice is that when you purchase a piece of equipment, a lot of times it's paid for in part with a loan. So you put some money down and borrow some money. The loan part goes here, but the entire purchase price goes in the asset purchase section. And I'll touch on that again. And then payments. The next few columns are loan payments. The total payment in the first column that's got the red above it, and then broken down into principal and interest in the second portion. And a lot of times you'll need to confirm that with the bank, because it can be different than what, like the bill they send can be different than what they actually credited because of timing and stuff. And to match up with your tax, the 1099 you receive at the end of the year, you want to make sure you've got the principal and interest portions broken down properly. And then finally, the ending principal owed is just a calculation. Beginning balance plus borrowing minus the actual payment. And that is the loan records. Next section is depreciation on asset purchases. So we'll have one last expense on the Schedule F. So again, the asset purchase itself isn't really what you deduct. It's the depreciation expense. But a lot of times, of course, you can depreciate things in the year you purchase them. And depreciation goes on line 14. So, but even though it's on the same Schedule F, it's not deductible in quite the same way as chemicals or feed. traditionally, it's you depreciate a purchase over multiple years. One thing that's important is land does not depreciate. So not every asset depreciates, and assets depreciate over different periods of time. And then also you can't depreciate raised livestock because they've been generating expenses. They don't get depreciated over their lifetime. But equipment, purchased livestock, buildings and improvement, those all are depreciable expenses. And there's a ton of options for depreciation. Traditionally, again, multiple years, but there's options to depreciate things in the first year you purchase them, and an assortment of combinations that you would want to talk with your tax preparer about. Depreciation can be a real good tax planning tool. So in the farm records book, there's a section for asset purchases. And so date, description, total price of the purchase. Again, the total price needs to include not just the cash amount you pay, but also any loan amount that you borrowed to purchase and at the value of a trade-in. So the total asset purchase price. And then the loan part is in the loan records, and the trade-in will be in the next section. Okay. Oh, well, and when you sell an asset, we'll tackle that now. Okay, so you have a gain. We talked about this in the first time we saw the table. It's the gain from the asset sales that goes on your taxes, and it'll go on a Schedule D. The amount of gain has to do with what you purchased it for, how long you've had it. That's called the tax base. It depends on the tax basis. And the gain is what's the sales price minus the tax basis is what, the kind of the definition. The type of gain depends on how long you held the asset. So whether they're short-term gains held not very long, long-term gains held a little longer, or depreciation recapture. I'll talk about those in a minute. But the idea is there are different tax rates for each of those types of gains. So if you hold an asset for less than a year, that would be a short-term gain. And that is subject to ordinary income tax rates. So the same rate that net farm income would be taxed at, and the same rate that personal income would be taxed at. Short-term capital gains are at ordinary income tax rate, whereas long-term capital gains, so things that you held more than a year, are taxed at that more special and usually lower capital gains tax rate. From a farm standpoint, it's important to note what the asset sales were, because breeding livestock and I think horses, some of the breeding livestock anyways, you have to hold them for 2 years in order to be a long-term capital gain. And then assets that are depreciated, like the purchased livestock, buildings, that depreciation has to be what's called recaptured at the ordinary income tax rate before you can take advantage of any capital gains tax rates. So if you bought a $100,000 piece of, say, equipment, depreciated all of it, and depreciated that entire purchase price, and then sold it for $10,000, then that $10,000, you'd essentially have to repay the depreciation that you took on it at that ordinary income tax rate. Whereas if you sold, say, a breeding livestock, raised breeding livestock, that would be long-term capital gains at that lower capital gains rates. And then all of the gains flow through to the 1040 at all their different rates. There's all sorts of calculations in the different tax forms, but they flow through to your adjusted gross income. And this is one of the reasons tax preparers are wonderful, because you're providing the information about what you sold, and they're going to, crunch all those numbers and figure out how that plays into the taxes that you owe. So the farm records book, you can keep track of all this stuff in the farm records book. And really what you want to be able to do is for the tax preparer to be able to match up what you sold and the amount you sold it for with the actual sale or the asset when you purchased it that they would have on your depreciation schedule. So you'll want to record the date that you sold it, the description of what you sold, again, so you can match that up with the original purchase price, the sales price, which is, of course, important. And if you know it, the date that you acquired it, again, for the purposes of matching that sale up with the original purchase of the asset on the tax preparer's depreciation schedule. So, and the livestock, again, you want to note whether it was raised cattle or purchased cattle, because the tax treatment is different, right? The raised cattle, like call cows, would be all long-term capital gains. Purchased cows would depend on the depreciation and have to be matched up on your depreciation schedule with their original purchase. Okay, so we have made it through each section of the business and how to record the different transactions. Looked at some of the places in the farm records book. And then, so section 1 is all the farm expenses, interest and depreciation. And then section 2, different parts for the different types of taxable income. And then I think Florence is going to talk more about the farm records book as a resource.
Yes. So I'm going to start sharing my screen. And I'm going to get started soon, but there were a couple questions that came in that, just to give people a couple minutes to stretch, get some water if they need, I'm going to see if we can address them. So the first one was, is it better to be a sole proprietor or LLC tax-wise? And I believe, and Corey, I would be interested in hearing what you think, but I believe if you don't need to be an LLC for transition planning reasons or otherwise, I would recommend being a sole proprietor if it just was for tax purposes.
For tax purposes, it doesn't actually change your taxes. If you are an LLC as a one-member LLC or a partnership taxed in an LLC, the taxes are exactly the same. What's different is the liability protections and some of the government programs and relationships with government entities are different when you are an entity like an LLC. But tax-wise, they're actually called disregarded entities. And there is types of LLCs taxed in certain ways, like certain kinds of corporations, that does make a difference. But from a sole proprietor or partnership standpoint, the taxes really aren't the deciding factor for LLCs.
Then another question was, when will the IRS publication 225 be sent to county offices? So county offices, yeah, I don't know how many county offices are open at this time. So my suggestion to you would be either contact your local farm business management educator. I showed a map a while ago, but or you could contact me and I can direct you to your local extension educator. Or you could also contact the Tell Farm Center, and they could probably send it like a box of them to you. Corey, do you know of anything else about that?
Some of the county offices have requested them and are getting them. Some of them, it's a little trickier this year because normally we would just take them to the county offices, but with travel being a problem during, with COVID restrictions, it's probably easier to just contact your educator and we can make sure that you get a publication 225.
You can also download it from the IRS website. I showed the link I think on the very, very first slide, which I know that it's not the preference for everyone, but that's another option. And then another question we got was, are payments for equipment leasing deductible? And I think, Corey, you wanted to answer that one?
Sure. So if you're talking about a lease for like equipment over 3, 4, 5 years or whatever, sometimes they're deductible and sometimes they're not. That is, it has to do with the commitment to buying the piece of equipment, and there's IRS guidance on that. That is definitely a question for your tax preparer.
Okay, there's another question that came in, so we'll probably try to answer this one and then keep going. So, Corey.
So the question is about, is there a difference between a tax preparer and a CPA? A CPA is that prepares taxes, is a type of tax preparer. There are people that are just tax preparers that are registered with the IRS. There are enrolled agents who are certified with the IRS, and there are CPAs, which is a professional designation that's not through the IRS, but obviously licensed separately and can represent you at the IRS level.
Thank you, Corey. Okay. So now we're going to show you in more detail how to get the Farm Records Book for Management. Like we've been saying, the Farm Records Book for Management is a free tool to keep track of your farm income and expenses, and it can be used in Excel, Google Sheets, or be printed off to fill out by hand. So you can open up a browser and type www.bit.ly/farmrecordsbook in the address bar and hit enter. And the Farm Records Book for Management will open. This will be a view-only version for anyone who wants to use this book to be able to download. You will need to make a copy of the document in order to use it. So if you just prefer to use pen and paper, you can just print it from here by clicking on the printer icon at the top left. And then on the next screen, select Workbook instead of Current Sheet for the whole Farm Records Book to print. Or if you prefer, you can print sections one by one by just leaving Current Sheet selected there. Make sure letter paper is selected and you should be ready to go. Hit Next. And once you do that, you will see a second and more realistic preview of what it's actually going to print like. So here you can take a few moments to make sure that everything is fitting right on your pages. And if the formatting looks correct, you're ready to print. Just select your printer of choice and click on Print. If you prefer to work on Microsoft Excel, you can download the file to your computer. Go to File, Download, Microsoft Excel, and an Excel copy will download on your computer. Once you do that, you can open it and it will look pretty much exactly like the Google Sheets version. If you want to print from here after you have completed it with your records, you'll be able to do that, but you may need to make a couple minor page adjustments. Your third option is to sign in with a Google account to use Google Sheets. If you are signed in, you will have a couple more options, and the one that you should use is File, Make a Copy. You will be able to select which folder in your Google Drive to use. Once you do this, Google is going to create a new copy of this Farm Records book that is now going to be editable. So you can just start entering information right away. And if you want, you will be able to print a filled in copy using the same instructions as before. Another thing you can do from your copy of the Farm Records book on Google Sheets is to share it with a family member or your tax preparer. This copy of the Farm Records book will be privately yours, so nobody else except those you choose will have access to your records. Once you make your own copy, MSU Extension can't see your stuff. So now let's dive a little deeper into how to use this Farm Records book. If you've just downloaded it, you can follow along, or you can just watch the screen captures I have here on the presentation. The Farm Records book has 10 sections, as outlined in the index, which is on the home page. On a daily basis, you're only going to deal with pages 1 through 3. Corey has been talking a bit about these pages, but we'll review some of it again in a minute. On a quarterly basis, you will check your work on page 4. Pages 5 and 6 have tables that resemble the most relevant tax forms so that you can estimate your taxes in December. And pages 7 through 10 are dedicated to creating financial statements and financial analysis. This is a little more advanced, so we will not focus on this today, but just know that if you want to be able to do farm financial analysis, but doing this yourself feels like it's too much for you, MSU Extension educators can create not only an income statement for you, like I said before, but also a detailed financial analysis, as long as you are able to put together the information for pages 4, 7, and 8, which are the cash flow statement, the production reports, and the balance sheet or net worth statement. So each section starts with an explanation, so you can learn a lot by just reading all that. But now we're going to go through an example. Let's imagine I'm a farmer. It's the beginning of July, and I am trying to finish up my second quarter records. I have already completed all of my first quarter work. So that means that I have gone up to page 4 for the first quarter. And as you can see at the bottom of page 4, I have checked that my beginning balance plus my income minus my expenses is equal to my ending bank balance. So inflows equal outflows. So now I am first going to go back to page 1 and finish entering my June expenses, including at least the date and amount, but like Corey said before, as much detail as possible. Then I'm going to add up each category for the month of June. As you see here, everything before June was already entered in this case. Then I add up the total expenses for June. And I do also have an employee which was not counted in the above expenses, so I have to add that information here. I enter his gross pay and any deductions and withholdings on this table. And I also bought a truck, so I'm entering that in the business property section. And if I would have borrowed or repaid any loans, I would enter that in the last table of this page. But I don't have any, so in this example, I'm just going to skip that. But all of these in page 1 were my expenses for the month of June in this case. Now I'm going to enter my income on page 2. Again, I enter each transaction on one line, entering at least the date and amount with as much detail as possible. And then again, I add each category for the month of June and come up with a total of operating expenses for June, just adding all of those up. For example, say I traded in an old truck when I bought the new one. So I enter that in the sales of business property section, including some information about depreciation as explained in the instructions. And now that I'm done entering all of my income and expenses, I am going to try and keep track of some personal expenses that may be relevant for tax deductions and adjustments at the end of the year on page 3. The Farm Records book does not have a place to track all of your personal income and expense transactions. My advice would be that you try and keep track of your personal transactions just as good as you do your business transactions. And like I've said before, there are tools to make that easy for you. That way you could know at the end of the year exactly how much you spent in the different personal expense categories. The logic of the Farm Records book, on the other hand, is to calculate your personal expenses as a difference between what you had at the beginning of the year and what you have now, taking into account any off-farm income and your farm income and expenses. It's just another way to calculate it. It is my belief that you should be able to double check, but many people do their personal taxes with no record keeping system to back things up. So I wouldn't worry too much if you're not getting this page done. So once I've entered all of these transactions for June, I'm ready to go to page 4 and do the second quarter closeout. But since this is broken down by quarters, I have to actually go back and add the transactions for April, May, and June for each income and expense category. And then I'm going to enter those totals in the second column in page 4. Once I do that, I can scroll down to the bottom of page 4 and I'm going to enter my beginning and ending cash balance. And I'm basically going to do the math to see if I've accounted for everything and make sure it jives. This will be the moment to enter transactions that have not been accounted for up to this point, such as any non-farm income and expenses, gifts, inheritances, savings, and that type of thing. So now going back to taxes, page 5 of the Farm Records book copies Schedule F so that you can try and estimate and manage your taxes at the end of the year. If you have been using the Farm Records book, you should have all the necessary information for that form. And page 6 copies the information requested in forms 1040, Schedule 1, Schedule A, and Schedule SE. Note that these are not official forms, the ones that you'll find on the farm records book. And also you may need to file more than those few forms. These are just the most common ones. So that's the end of this part of the presentation, and we have 5 extra minutes. So let's see if there are any more questions we could answer. And it looks like there aren't. So we'll just give it a couple minutes to see if anybody types anything. Or
there were a couple questions asking about the web site to get the farm records book. That might be a good thing for us to include in a follow-up email when we send a link with the video.
Okay, I didn't see those, but I can definitely do that. I will send a follow-up email, probably with the recording of this webinar. Oh, I see. What web address for farm book? What is the website? I see it here. Okay, I'll send all of that information in a follow-up email. But let's see if I can type the address. bit.ly/farm records book. See if you all can see that. Oh, I saw, Corey, that you had also sent that to her. Yeah, that's for the farm records book. And the other one was called bit.ly farm cash track, I think.
And another thing we can send in the follow-up email is the information for each of the local farm management educators, so you can contact the one in your region.
Okay, I can do that. Do you have a form for keeping an inventory? Trees in my case. There is a question. I don't think so. I don't think there's anything preset that we can offer you. If I was in your situation, I would probably just create Google Sheets. I tend to like working with Google Sheets, but Excel would work just as well. Yeah. And I'm sure there's like softwares that you can purchase for that as well, depending on, you know, your preference. Corey, do you have any like other good answers for that?
You could adapt some of the information in the farm records book, but I think that a separate spreadsheet for people that are comfortable with spreadsheets are probably going to want to have a separate spreadsheet for that.
Yeah, or you could add a page or add a sheet to, if you're using the farm records book or another spreadsheet to keep track of transactions, then you could add another, like a tab. There's somebody that can't see what we're typing, and I think you probably want to go to the top of the question and answer window if you have that open, and go to the second, third, depends, tab at the top. There in my screen it says answered, and that's where you could see what other people have asked and some of the answers we've typed.
And all of that information, we'll send all of that information in a follow-up email, because this moved fast. I know this is a lot of information all at once, and we can provide the links and such, so you have a record in your emails.
Yeah, and also, by the way, I would love to stay in touch. So send me an email with any questions you have. I can get Corey to help with some of those answers, or find out answers otherwise. Yeah, so please stay in touch. Okay, well, we still have an extra minute, so no more questions. We have a thank you here, and it looks like we're done. So I'm not going to hold people up any longer if there's no more questions. So thank you everyone for coming, and we'll see you in the next one.